After years of historically strong, somewhat insane rent growth, things are starting to cool off. But the question is this cooling a return to normal growth rates, or will rents continue to fall and actually turn negative? Or perhaps could we see rent growth start to take off again? In today's video, we're gonna look at how rents are coming back down to earth across the country. We're gonna talk about the differences between single family rents and multifamily rents, and we'll talk about how a potential recession might impact rents across the nation. And as I usually do, I'm gonna start with broad national trends, and then we'll discuss some regional variances and specifics about some individual markets towards the end of the video. And at the very end, I'll share 3 pieces of advice on what investors should do with the information we're going to discuss today. So let's start first with the big picture. Rents on average, or the median rent in the United States, is about $1,750 according to Yardi Matrix. And it's kind of funny, if you look at rent data across different sources, they can vary wildly. Like Zillow shows it close to 2,000, whereas Yardi Matrix, which I think is really reliable, shows 1,750. So we're going to mostly show Yardi Matrix data here just as a heads up. And what this reflects is about a 3% increase year over year, which is about the pace of inflation. So that I would consider is somewhat normal rent growth. And so that's not really that notable, except that for the past 3 or 4 years prior to this year, they were growing at, sometimes 15, 20%. But in the last 2023, most of 2024, it was something in the 4 to 5%. So we are coming back down to a more normal level. And if you actually dig in further to this data, you can see that there's differences between different tiers of properties. For example, luxury properties are actually growing the fastest. And this isn't always the case. You might think, yeah, luxury grows the fastest. That is not always the case. But right now, high grade, high tier properties are growing closer to 4%, whereas lower tier properties are closer to 2%. So just something to think about if you're an investor, if you're trying to underwrite a deal and you're looking at a lower tier property, you may want to forecast some lower rents. Just something to think about. So we are in the highest level, we are seeing rents continuing to grow. But something I want to call out is this rental market has somewhat of a disguise, right? It's looking like rents are growing up, but I want to talk to you all about something called concessions. If you haven't heard this term before, it's basically when a property manager or property owner offers free rent or other promotions to get people in the door. Sometimes when you're driving by a multifamily, you see those big banners like move-in special. That's a concession. So it doesn't necessarily mean that the property owners are charging lower rent, but it means they're giving some sort of financial benefit to potential renters and to new tenants, and that actually lowers their revenue and lowers their profit. Meaning that property owners, even though rents are going up 3%, are probably likely making less money. It's just not being reflected fully in those rent numbers, right? Because they're charging the same amount or 3% more, but they're saying, hey, we'll actually give you a month off rent, which actually reduces their revenue by 8%. If you look at this chart from Zillow, you can see that concessions have been rising steadily for the last couple of years and are now at a point where about a third of all properties are offering concessions. So we don't know exactly what the net effect on rents are, but it's something to think about when you look at rent data. Now, this always exists. As you can see, even during really strong markets like February 2022, about 20% of properties were offering concessions. So this is always a variable, but right now it is even more of a variable than normal. The last thing I want to break down here before we go into some regional differences in multifamily is actually some positive news on a overall national trend. That is that affordability has returned to a critical level, which is that on average, renters are paying about 30% of their income towards rent. And this number is basically what budgeting and personal finance experts recommend, that people who are renting shouldn't spend more than 30% of their income on rent. And normally it's about 28, 29%. But during the pandemic, it shot above 31%, which is obviously not a huge increase, but psychologically that is a big difference. And it has come back down to a more normal level of about 30%. And the reason I say that this is a positive thing is because having quote unquote rent burdened people is not good for the economy. It's not good for society in general when people can't afford housing, but it also creates conditions for instability. You see more vacancy rates, you see more evictions, and that's not good for anyone. I'm actually working on a project right now that shows how the cost of evictions, both for tenants and landlords, and it's huge. And so getting rental affordability back below this 30% threshold, I think it helps everyone, investors, tenants, all of society. So I was happy to see that. So that's what's going on nationally. Let's take a quick look at some regional variations that we're seeing. If you look at this chart here, again from Yardi Matrix, you can see that the spread between different markets is huge. Looking at Boston, we're seeing rents that are still like in the pandemic levels of growth, 15%, or Lansing, Michigan, Raleigh, Durham, close to 10%, way above inflation, way above historical trends. On the other end of the spectrum, when you look at a lot of the markets towards the bottom, like Baltimore, Phoenix, DC, you're seeing that single year-over-year rent growth has actually gone negative. And so it's super important as investors to look at the individual characteristics and what's going on in your individual market. And if you're thinking, what gives here? Why are markets growing? Why are some declining? Well, there's a lot of complicated factors. It all boils down to supply and demand. But I think the number one variable that you should be paying attention to is multifamily supply. And yes, this is even true when you're looking at single family rents. You need to be looking at how much competition is out there, basically. Frankly, with single family, there's just not that big of a change year over year or month to month because construction is relatively slow and we see relatively stable numbers of apartments coming online. However, with multifamily, starting in 2021, there was just this construction boom. And even 3 years later, we're still feeling the effects of that. And tons of apartments are still coming online and are being offered right now for the first time. So that means supply in many, many markets is going up at a time when there's maybe a recession on the horizon, where inflation has been high for years, and demand is cooling a bit. And so in markets where there is a lot of multifamily supply, think places like Austin or Charlotte or Phoenix, Raleigh, these types of places are seeing so many new apartments coming on that it's causing a lot of competition among property owners and property managers. And the way that people compete for tenants when there's a lot of competition is they lower rents or they offer those concessions. And so if you're trying to forecast what's going to happen in your market, that's the number one thing I would look at is, are there a lot of multifamily units coming online? And luckily, this is all public data. You can go just Google multifamily construction permits in your market or multifamily construction completions in your market and see what the trends are like. If they're higher than historical average, you should probably forecast some declining rents or at least flattening of rents from where they are. So that's where we're at. Rents are up nationally about the pace of inflation, but there are obviously variations in different tiers. For example, like we talked about, luxury rents are up higher than lower tier rents, and there's going to be huge variances regionally. We see a lot of markets in the Midwest and the Northeast with strong rent growth, forecasted for continued strong rent growth, whereas a lot of the areas where there's been multifamily booms, mostly in the West and Southeast, we see slower rent growth and even declining rents in some places. The question then is, what happens from here? And I think that there's two big factors. I already told you about the first one, which is multifamily supply. You'll see, again, in these places like Austin and Raleigh, so many multifamily coming on, it's likely that rents are going to be soft, whereas other places like Indianapolis or Philly, they have more balanced multifamily supply. They're going to see stronger rent growth. And in addition, though, I want to talk about a second variable, which is the recession question. I get this question a lot. People want to know if there is a recession, which there might be, but we don't know yet. If there is a recession, will rents decline? And I pulled this chart from the Federal Reserve Bank because I think it shows really succinctly and well that rents tend to just keep going up even in recessions. This chart is super cool because those vertical gray lines there are periods of recession. And what you can see is that we have 6 recessions on this chart, and in 5 of them, rents went up during the recession. Now, the notable exception, of course, is the great financial crisis. Rents did go down in the single digits during that time. Comparatively, home prices went down like 20%, so it was still more muted. But it's important to know that rents typically continue to go up during a recession. And if you think about that, that kind of makes sense. And if you look at the conditions today, I do think that's the most likely scenario. Of course, rents could decline on a national basis in a recession, but what happens typically in a recession is that rentals become more affordable than homes. And that's definitely what's going on right now. If you look at housing affordability, it's near a 40-year low. And in almost every single major metro area, it is cheaper and a better financial decision for people to rent than to own. Now, people want to own their homes for other reasons other than financial, but if you're just trying to make a strictly logical financial choice, a lot of people would choose to rent, and that means demand for rentals are likely to stay high, and that should help rents at least maintain their current rate nationally, if not grow a little bit. That said, overall, my expectation is for rent growth to be below the rate of inflation for the next year. Like I said at the beginning, right now it's about the same, 3% roughly. But I think we'll start to see rent growth on a national basis come down to maybe 1% to 2%. And I think inflation's probably going to stay in the 2.5% to 3% for the next couple of months. Meaning, on average, investors are going to be losing some profit in real dollars. And real dollars just basically means inflation adjusted. So when you, like I said, if rents and revenue are growing only at 1.5%, but inflation's 2.5% or 3%, that means in terms of spending power, you're going to lose money. Obviously, that's not for all investors, for all properties, but that is my expectation on a national level, at least for the next year. So the question is, what should you do with this information? Well, I have 3 pieces of advice. First, try to control expenses as best as possible in the coming year. Focus on efficiency of operation. So get really good at working with your suppliers, your contractors, to make up for the possibility of those inflation-adjusted losses and revenue declines. The second piece of advice is stick with good tenants, because other landlords are going to be offering concessions, as we talked about, and potentially lower rents. So don't push up rents on great tenants. And this is honestly always true regardless of market conditions, but it's especially important when renters and tenants, good tenants, have other options that might be cheaper than your place. Third, if you're buying a new investment, make sure to underwrite your deals and forecast lower rent growth, I'd say for the next 2 or 3 years, just to be safe. Probably won't be suppressed that long, but I'm personally a conservative investor, and given all the economic uncertainty, I recommend you do the same, especially in cities where there is a lot of multifamily growth. I'd say forecast no rent growth, or maybe 1% rent growth for the next 2 or 3 years, just to make sure you're being super conservative and don't find yourself in adverse conditions. All right, everyone, that's what we got today. Hopefully this information about the rental market helps you plan your next investment or helps you plan how to manage your existing questions. If you got any questions about any of this data or information, you can always hit me up on BiggerPockets or on Instagram, where I'm at The Data Deli. Otherwise, I'll see you back here on the BiggerPockets YouTube channel in just a couple days. Thanks for watching.